In terms of independence, some specific areas that the Code of Professional Conduct deals with, one of them is your financial interest. Financial interest in one of your audit clients could be a direct financial interest or an indirect financial interest. The difference behind these is just the level of control that you have over your investment, the level of control that you have over the company. If you have shares in a company, how much control do you actually have in that company and what they do? So in terms of your financial interests, the problem with this is that if you have a financial interest, if you have shares or securities within a client and you are auditing them, it is very easy for it's very easy for people to assume that your interests aligns with the company's. So we worry that the directors may have manipulated the financials to show better profits. And obviously my concern is if you as an auditor are also interested in profits, there's a possibility that you would overlook that manipulation. There's a very clear self-interest threat to your objectivity. The fundamental principle at stake here when we're dealing with independence issues, at the very least, is always objectivity. The safeguard: dispose of that financial interest until it is no longer material. It doesn't necessarily mean that you need to give it up entirely, but we're talking about reducing the holding or reducing that financial interest until it is considered clearly insignificant. If it is a team member, one of your audit team members, one of your clerks maybe has shares in a company or has financial interest or has a family that has financial interest, perhaps the best way to deal with it is simply to remove that team member. Governance structures within companies. We've spoken about audit committees that are responsible for the financial reporting of the company. They have the responsibility to have assurance, and they get the assurance about the independence of the auditors. So notify them and identify whether or not the audit committee at your client is comfortable with your financial interest as well. And there's a possibility that maybe you get an additional independent review. So once your audit has been done, get a third party, an independent reviewing, to see whether or not they're comfortable with the work that has been done and the independence they're in. And if there are no other safeguards that can reduce that financial interest and that self-interest threat to an acceptable level, you will have to give up the audit and walk away from the audit. In exams, this is the way that it needs to be structured. You need to talk about what the threat is. The financial interest may make it easier for someone to overlook a misstatement because they have an interest that is aligned with the company. It creates a self-interest threat to objectivity, and then your safeguards, these are the possibilities depending on what the situation is. And again, one of your safeguards, if nothing else can be done, you give up the audit, you walk away. You can never be doing anything as far as the Code of Professional Conduct is concerned that will discredit the profession, which means rather give up the audit and walk away from the job than let the profession be discredited.